What if Tesla's stock is on the edge of its biggest correction in years? After rallying nearly 100% since April, some analysts now warn of a 30% crash right before earnings. Could this be the start of a new bear phase? Or just the calm before another explosive breakout? If Tesla really drops to $300, how will it impact the broader tech market, and could Elon Musk's next move decide everything? You're watching StockScope AI, where we decode the global moves behind tech, AI, and financial markets. No matter where you are in the world, if you want deep insights on stocks and innovation, subscribe now, and let's continue the video. Tesla's stock has been unstoppable for months, doubling in value since spring. But after touching new highs, something changed. The rally stalled, the volume faded, and now the stock trades around $430, unable to break higher. With third-quarter earnings just days away, traders are asking, is this consolidation healthy? Or a warning? Some analysts, including teams at Industrial Alliance Securities and Evercore ISI, are predicting a 30% downside, cutting their targets to $300. That's a bold call, and it comes at a moment when Tesla's valuation is stretched. A price-to-earnings ratio near 250 leaves little room for disappointment. And if history repeats, even a small earnings miss could trigger panic selling. The bears argue that Tesla's margins are cracking. Price cuts across its lineup have eaten into profits for several quarters. Even though third-quarter deliveries were strong, investors didn't cheer, they sold into the strength. Why? Because expectations are already maxed out. Some traders say Tesla's current setup eerily resembles past market peaks rallies that ended right before disappointing earnings. The fear now is simple. Even a good quarter might not be good enough. Add in growing competition from Chinese EV makers like BYD and NIO, plus high interest rates affecting car demand, and Tesla's perfect story starts to show cracks. But there's more. The stock's sideways trading pattern signals that bullish momentum is fading, and with tech valuations stretched across the market, Tesla might be one of the first to correct hard. Still, not everyone is panicking. The bulls, and there are many, believe this weakness is only temporary. This week, Melius Research reiterated its buy rating and raised its target to $520, implying nearly 20% upside. RBC Capital Markets also stood firm, highlighting Tesla's AI and robotics potential, especially its Optimus humanoid project. Their message is clear. Tesla isn't just a car company. It's a technology platform combining energy, software, and artificial intelligence. And in a world pivoting toward autonomy and electrification, Tesla's scale and vertical integration give it an edge competitors can't easily replicate. Even during pullbacks, long-term investors treat dips as buying opportunities, a pattern that's repeated over the past decade. For them, Tesla's story is about the next 10 years, not the next 10 days. The truth lies somewhere in between. Tesla's fundamentals remain strong, but so do the risks. The question investors should ask isn't, is Tesla executing well? It's, is perfection already priced in? A P/E ratio of 250 means Wall Street expects Tesla to grow earnings at extraordinary rates for years. But in a cyclical, capital-intensive industry, that's a huge challenge. Combine that with the 100% rally since April, and even a minor miss in margins or guidance could trigger a sharp 20 to 30% pullback. The stock's recent hesitation, no new highs in weeks, is a warning sign that buyers are running out of fuel. And in a market already stretched by optimism, Tesla's high valuation makes it one of the most vulnerable names in tech. So what should investors watch when Tesla reports earnings next week? There are three key areas. First, margins have automotive gross margins stabilized after months of decline. Second, AI and robotaxi updates any progress toward monetizing its autonomous driving or Optimus humanoid projects. And third, regional demand trends, especially in China and Europe, where EV competition is heating up. A strong report could reignite the bullish momentum and silence the critics. But if margins disappoint or if guidance turns cautious, the bearish calls from Evercore and Industrial Alliance could suddenly look justified. So, should investors panic? Not necessarily. Tesla remains a revolutionary company with unmatched innovation and brand power. But that doesn't mean the stock can't correct sharply before the next leg higher. In markets, even the best stories need pauses. Whether Tesla crashes or consolidates, it's clear that the coming earnings report will set the tone for the rest of 2025. What do you think? Will Tesla drop to $300 or surprise everyone with another breakout? Share your thoughts in the comments below, and if you want more in-depth analysis of Tesla, AI, and the future of tech investing, subscribe to StockScope AI and stay tuned for the next update.